So Feb March 2017, question number 4. Come on, what is the difference between a cost unit and a cost center? What is a cost unit?
Cost center is the one place where the costs are there.
Where you attribute the cost, where you put the cost. But what is cost unit? Anybody?
Like 1 unit of production.
Cost unit is the unit of production. Very well. What is a cost center?
Department in a business where you can attribute a cost to.
Yes. Department of a business where you can attribute the costs. Okay. State the difference between production cost center and service cost center. Anybody?
Production cost center is where the department is directly related to the production of the goods.
Okay, they're directly involved in production of goods. They're directly involved in production of goods. And what about service cost center?
They're not directly involved, but they give support for the production cost centers.
Okay, so service cost center is not directly involved in production of goods, but they give service to the production cost center, but provide service to production cost center. Okay. What is contribution?
Revenue minus variable costs.
The difference between sales and variable costs is contribution. But only if you write this much, you're going to get 1 mark. What else can you write?
The amount is used to recover fixed costs and it contributes towards providing profit.
Okay. Contribution tells us the amount each unit will contribute towards the recovery of fixed costs. I hope everyone is clear till here. Yeah. I hope everyone is clear till here.
Yes, ma'am.
Yeah, please tell what is it. I'm going to the next part.
Miss, I need to copy.
You don't need to copy, you need to learn and write. Now we are doing the sum. Just
तो
be
सही.
it as in the sum, okay? What are we supposed to prepare? MIU currently uses marginal costing to value her inventory. Marginal costing to value inventory means what? What do you mean by marginal costing to value inventory? It means when I'm using marginal costing to value inventory, it means I value my stock at which price? Variable cost. I have been given the following budgeted information for January and February. Selling price is 12. Variable cost is 5. Okay. There is fixed production overheads in January and February, same amount. Fixed administrative costs, January and February, same amount. So the total fixed cost is how much? For Jan, it is 9,800 and for Feb, it is 9,800. Now, if you look over here, in January, my sales is 3,600, but my production is 4,500. Since the unit produced and unit sold, is it the same or it's not the same?
Not the same.
Unit produced is not equal to unit sold. That means for the month of Jan, I will have closing inventory. How much is the closing inventory? 4,500 minus 3,600. For the month of Jan, I have closing inventory 900. Can you all tell me how will you value this closing inventory? Which cost?
The variable production cost?
Variable production cost. What is the variable production cost?
$5.
5. So my closing inventory for Jan would be 900 into 5. That becomes how much? 4,500. Are you with me?
Yes, miss.
In February, this 4,500 will become the opening inventory. Okay. Now let's see. Sorry, 900 units will become the opening inventory. In Feb, you have produced 4,500 units and you've sold 5,400 units. That means you've also sold the opening inventory. 4,500 plus 900 is 5,400. Anybody has any doubts for this?
No.
No? Okay, I have read the question. Now, what they want me to prepare? They want me to prepare a budgeted profit statements for 2 months, Jan and Feb. Okay? Using marginal costing. Marginal costing means sales minus variable costs, contribution minus fixed cost profit. So I will first prepare for January. Now, normally, they clearly want us to show the opening and closing inventories of each month. This statement is there. If this statement would not have been there, I would have done for January. How much units have I sold? 3,600 units. And for February, I would have done for 5,400 units. But because this statement is there, I have to show opening inventory and closing inventory of each product. Come on, tell me, we will start with what first? Sales. For January, what is my sales?
3,600.
What is the selling price?
12.
So 3,600 into 12.
43,200.
Can we do a working first to just calculate the amounts? So I'm doing sales. For January, it is 3,600 into 12. And for February, it is how much? 5,400 into 12. Give me the amounts.
For Jan, it's 43,200.
This is 43,200. And for February, it is
64,800.
64,800. Then minus variable costs. Now we will take the variable cost, but if you remember, they clearly want us to show opening and closing inventory. When they want us to show opening and closing inventory, you will write variable cost, but you will treat it as cost of sales. What will you treat it as? Cost of sales. So it is called the variable production cost or variable cost of production in marginal costing. You will write this, but you will treat it as this. Opening inventory, purchases, or here we will do the production minus closing inventory. Is there any opening inventory in Jan? No. Production was how much? How much was the production? 4,500 units into $5. And for February, what was the production? Are you all with me? Is there closing inventory in January? There is closing inventory in January. It is 900 units. I compared the number of units produced with the number of units sold. And in marginal costing, what do? I take only the variable costs while valuing inventory as per marginal costing. So this closing inventory will become my opening inventory of February. It's 900 into 5. This is 4,500. Opening inventory plus production, and there is no closing inventory. So I have just done dash. Now I'll make my statement. Okay. So this would be my working. Now I'm making my statement. So I'll take sales. What is sales for Jan? I'll directly take this amount. Minus variable costs of production. This would be opening plus production minus closing. I don't have any opening. My production cost was how much? 22,500. My closing inventory is how much? 4,500. So what is my total variable cost? 18,000. Then I'll get my contribution. $25,200 minus fixed costs. What is the fixed cost? 9,800. I'll get my profit. 15,400. Just digest this fact and tell me if you all are with me. I did this working separately because I couldn't write number of units into selling price over here. If I write for 1 month, then the second month would go haywire, and I couldn't even show it over here. So that is why I did the working separately. You all have the option to show the calculations over here and just multiply and put the amount and everything in one column. Is
Yes, it lose
everyone
marks if
okay
you
with
don't.
Jan? So I can
So
go.
what? Only Jan.
Sorry?
So this is only Jan, na, which you
Yeah.
did.
Anybody has any doubts? Come on, let's talk for February. What is the sales for February? 64,800. What is the opening inventory for February? The closing inventory over here would be the opening inventory for February. So opening inventory is 4,500. What is the production cost for February? 22,500. And there is no closing inventory. So what is my cost of production? $4,500 plus 22,500. It's 27,000. Sales minus production costs. Contribution. Minus fixed costs. I get profit. 28,000. So what is the total profit for the 2 months? Total profit for Jan is 15,400. For February is 28,000. So your total will be 43,400. This working, if you are doing it, just show it over here. Are you all with me?
Yes, ma'am.
Oh, there was sufficient place, so you could do it over here only. It's fine. I just pasted the question, that is right. So did this we made the budgeted profit statement. Okay, as per marginal costing. I hope everyone is done with this.
Yeah, I'm done.
Now she's considering to use absorption costing to value her inventory. What is she considering to use? Absorption costing. Absorption costing means that overhead absorption rate. To value her inventory, Calculate the production overhead absorption rate. What is the production overheads?
$9,000.
So we calculate the overhead absorption rate by using this formula. But overhead absorption rate is budgeted overheads upon budgeted activity level. So what is my budgeted production overheads? 9,000. What is my budgeted activity level? 4,500. So overhead absorption rate is $2 per unit. Per unit, why did I take as activity level? Because they wanted it per unit. And we have no hours also. Are you all with me?
Yes.
Okay. Now they want us to prepare for the 2 months Jan and February income statement using what?
Absorption costing.
Using absorption costing. And when they are using absorption costing, they want to calculate the inventory how? Value of inventory. How do they want to calculate the value of inventory?
Using overhead absorption rate.
Using the overhead absorption rate. This is what they have told us. Okay? Are you
Yes,
all with
miss.
me? Come on, let's do it. First, let's prepare the working the way we did in last sum. We are preparing income statement as per absorption costing. So first thing we have sales. What is sales in January? $3,600 and sales in February is 5,400. Multiply with the selling price. Okay. Minus, what will we do? Cost of sales. What do we do?
Cost of sales.
Cost of sales. But this is what costing? Absorption costing. No problem. What does it matter? In absorption costing, it is like our normal income statement. The normal statement that we prepare. So first we have opening inventory. Add purchases. Minus closing inventory. Now look over here very properly. In marginal costing, we valued our inventory at how much?
Variable production cost.
At variable cost, which was 5. But in absorption costing, we value our inventory at variable cost plus fixed cost. That is the total cost of production and not only the variable cost of production. But in this sum, they have said that they are considering using absorption costing to value inventory. And in absorption costing to value inventory, they are calculating the production overhead rate per unit. That means in absorption costing, variable cost will definitely come. What is the variable cost? 5. But apart from that, the fixed cost. the production overhead rate per unit will also come. So inventory or your production would be valued at $7. Please digest this fact and then tell me. Are you all with me?
Yes,
Are you all with me? I am waiting for your reply.
Yes, miss.
So you all understood that in absorption costing, your production, your opening inventory, or your closing inventory, everything will be valued at the total cost. That means you will also consider the fixed cost of production. And we got an overhead absorption rate, production overhead absorption rate of $2 per unit. This was for the fixed costs. Are you all with me?
Yes, miss.
Okay, fine. Is there any opening inventory over here in January?
no.
Purchases or production? What is the production? 4,500 into 7. What is the closing inventory? 900 into 7. So I did sales minus total cost of production. But I just need this information. Then when I make income statement, I will do the other things. What is opening inventory for February? What is production for February? And there is no closing inventory for February. Are you with me? Are you all with me?
Yes, miss.
So my working gets over here. Now I'll prepare my actual statement as per absorption costing. Start. Sales minus variable cost of production or minus cost of production, I will say. You can also say cost of sales, opening inventory plus production minus closing inventory. What is opening inventory? There is no opening inventory. Production is 31,500 for January and closing inventory 6,300. So this is 25,200. Sales minus cost of production. Will give you what? We don't write contribution over here. Minus, what will you do? Here I have to minus everything to get the profit. The variable cost also and the fixed cost also. So there is a fixed administrative cost, fixed admin cost of 800. So I get 17,200 as my profit. In marginal costing, we ignore this and that fixed overhead. But in absorption costing, we take everything.
So why do we skip?
Sorry,
Why do you skip this fixed administrative cost?
marginal costing is short-term decision-making technique. So I just want to know in the short term whether I should accept an order or no. I should buy a product or make a product. So we only want whether my any money that I'm getting is able to recover my variable cost or not. And then to see the profit, I just minus the fixed cost together and get the profit. Over here also I have minus the fixed cost, but after contribution. And over here I have split it into two parts. Production cost separately and office cost separately. This is like my normal income statement. Let's go to February. What is the opening inventory? Opening inventory 6,200. Production cost is 31,500 and there is no closing inventory. So this is 37,800. Cost of sales or cost of production. Fixed cost is 800. $26,200. My total profit is 43,400.
Is the profit same?
The profit is the same. The total profit will be the same. But the monthly profits will have variation.
Oh.
Are you all with me? Are you all with me?
Yes, ma'am.
Okay. This was my total profit as per marginal costing. I'm just copying and pasting it down. This was my total profit as per marginal costing. For January, it was 15,400. And as per absorption costing, it is 17,200. Can you all see this?
Yeah.
Can you all see this? Why could have this difference been arised? Why
Because
it
of
was
the-
more as per absorption costing and why it is less as per this marginal costing? It is because of closing inventory. Why? Because of inventory. Because over here, you have valued inventory at 7. And in marginal costing, we valued inventory at how much? 5.
Fine.
Okay. So how do we do it? Now I'm giving you a shortcut to do it. You can start with any profit that you want. Tell me which profit you want to start with. Marginal or absorption?
Marginal.
Okay, start with marginal. So I'll start with profit as per marginal costing. It is how much for January? 15,400, and how much for February? 28,000. Okay. What is the profit as per absorption costing? Profit as per absorption costing is more. Why this is more? Because here you valued your closing inventory. Now another hint you'll remember, I normally keep on saying when I have to reconcile, closing inventory is income and opening inventory is expense. So here in absorption costing, I valued my closing inventory at 7. And here I valued my closing inventory at 5. So here I have valued income at more amount, that is why this is more. So if I want to make this equal, what will I do? I have valued inventory at 5, value it at more 2. So I will add difference in closing inventory. So 900 units, you will just, the 2 rupee difference you will add back. So you will get this profit as per absorption costing. Did you check?
Yeah.
Okay. Come on. What is profit as per absorption costing of February? 26,000. Why? Because here the opening inventory valuation was different. Opening inventory means expense. So here you showed more of expense. That is why this profit is less. And as per marginal costing, it went more because you showed expense at 5. That means at inventory. So from year to year, if I have to come, I will do less. Difference in opening inventory. It was 900 units into 2. So here you showed what? Less expense. So your profit was more. So you subtract it. I normally don't do it like that. I just write it. And I know that the difference is because of closing inventory and opening inventory or inventory. So go and check the inventory level. Here there is only one inventory. There you valued at 5, here you valued at 7. So that inventory into the difference. In this add and less, I decide as per the answer. This is how I do. Please digest this fact. I'm waiting for you. So marginal costing is used for short-term decision making, whereas absorption costing is used for long-term decision making. What is good? Short-term decision making is good or long-term decision making is good?
Yes, it depends on the situation.
What is your situation?
I don't know.
Absorption costing will be used in the long run. It will help to set prices.
But it can be more complicated.
Absorption, sorry?
It can be more complicated to use than marginal.
Yes. Absorption costing is more competitive.
So what is that? Long run, it will help to prices.
It will be used in the long run. It will help to set prices for future for your product. Absorption costing is acceptable and realistic for financial statements. Therefore, it is advisable to change from marginal costing to absorption costing.